Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again my almost every week guest, Michael Oliver. Thanks for joining me again, Michael.
Jay, good to be back. Thanks.
Always good to have you, and it's always good to tell my listeners OliverMSA.com. Oliver, M as in Mary, S as in Sam, A as in Albert.com to keep up with Michael and hopefully to subscribe to his excellent newsletter, which, as I just mentioned before the break, it's a can't do without missive that comes out several times a week on various markets. Always very helpful. And I would say, Michael, in particular, what's helpful to me about your work is to get a sense of the major trends that are going on. I'm not trying to trade hour by hour or day by day even. I'm looking to have a sense of where my portfolio should be weighted in which sectors, which areas of the market. So that's what's very helpful. You like to look at relative performance a lot, which oftentimes gives you a better sense of the big picture of what is taking place in the markets. Can you talk to our listeners a little bit about some of the sectors that have been outperforming and you expect will continue to outperform, and what that may be telling you about the bigger picture, the macro picture, if you will?
Mm-hmm. Sure. I think the commodity asset category, which of course is almost always led by gold, both in terms of the net price trend direction of that category. Gold will turn up first, then commodities later. But when you relative assess gold versus, for instance, in the weekend report just passed, I measured it against the Dow Jones World Index, stock index. And sure enough, it echoed what happened early this year in the measurements of gold versus the S&P, which is to say it broke out upside. Mm-hmm. Since 2011, when gold topped, not only did its price top, but it went down while the S&P went up, and therefore the relative performance of gold was not only negative, but even worse when you exaggerate by the upside in the S&P. But when you measure that on a spread basis, one versus the other, ignoring the price charts of each individual one, but putting them on a spread chart and then running momentum of that spread, I use annual momentum often or quarterly momentum, we had a 3-year base, wide base in the gold versus S&P spread. We broke out in January, where anybody with a crayon who was plotting this chart could say, oh my goodness, there's a change, big change. We're dealing with monthly readings, not daily. And again, we're not focused on price, we're focused on the difference between the two, the valuation levels. That was a major turn. Silver broke out as well. The GDX, the gold mining sector, which had been beat off the page, broke out versus the S&P, not just having a nice rally while the S&P went down, but breaking a multi-year basing structure. This has happened. This is also about to happen with the emerging markets, which, as we all know, are commodity-based or largely commodity-influenced, and they've been beat up while the S&P went up. So their relative performance has been bad. But it's now about to shift in the wake, probably, of the early signal by gold. The XLE, the energy sector, which has been vastly beat up in the last year and a half while the S&P has gone sideways, is on the cusp of turning up versus the S&P. The metals and mining sector, I'm talking base stuff now. XME is the ETF for it. This would be iron ore type people, copper miners, and so forth. That has broken out of a significant base on a relative performance basis versus the S&P. So what does this all mean? Well, what it means is that the investors out there, at least the initial wave, are starting to reassess their position, favorability rating of the stock market versus commodities, and they're shifting back to commodities. This is something that prevailed, for example, around 2000 low in most commodities. If you'd have bought a basket, right now the Bloomberg Commodity Index or the CRB Index, if you maneuvered yourself into a position of owning commodities versus stocks, you beat the pants off the stock market. That changed in 2011. We had a major decline in that relative performance that lasted several years. Now it's turning back up again. So I see this asset class shift preference, and obviously it's led by what we call the smart money, whoever they are, where a few, 5 or 10% of investors start to shift their assets, and it starts to show up in these spread relationships. And then later on, when the public gets wind of it, then the money flow starts even more obviously. So I think that's what's underway. And I think it disfavors stocks, favors commodities, certainly gold, favors gold over the S&P. And I think this means something. In the weekend report, I've done a lot of spread measurements of the yield curve. And as we know, because of the central banks, the long end of the market, 30-year bonds, 20-year type instruments, and so forth, have driven down in yields to have squashed the yield curve down to levels we've never seen before, where long-term debt yield is approaching short-term debt yield. This looks like it's ready to change as well. When I measure the momentum of these yield curve measurements, it suggests to me that this depression of the yield on the long end is about to snap and go up. Now, that's the end of the market that the Fed controls the least. Yep. 30-year bonds, so forth, 10-year notes, similar instruments in Europe. What does it mean? Well, if I see a potential turn up in the yield market, the long end of the market, rise in yields, drop in price, that could also be in the wake of what? A commodity upturn.
Sure.
The central banks have been hoping and praying for their 2% inflation. What I'm seeing in the charts is there's the potential here you're going to get a lot more than that out of the commodity end of the world. A lot more than 2%.
Yeah.
In some of these markets, it'll be a genuine bull trend, gold. I think oil could have a major bear market rally up to about $60. And now, if you take oil from under 30 and you take it to 60, there's no 2% in there. I'm seeing the same thing in copper. Corn is breaking out on my momentum work. Sugar's already broken out. So the walls are crumbling here, and the central banks, which provided the liquidity for this to happen, but it was delayed until the investor finally made the decision, okay, I'm going to move some of that flow of liquidity out of my stock position and into a commodity position. And I think they're going to be shocked by the percent gain that they get out of commodity inflation metrics. Probably that's apparent by the end of this year, even.
So there could possibly be some money, I would think, finally made on the short end of the U.S. Treasury market.
Yes, that would be a lagged effect, I think, but that would be a traumatic one. Think of what it does to the real estate market if you suddenly increased long yields by 75% above where they are right now, which even then the yield would be historically low, but it would be a sharp change. What would it do to, for example, the high-yield debt issuers who are already in trouble?
My goodness. I mean, it's...
So there's a lot of things interconnected here that appear to be either one, have already been signaled, or two, are on the cusp and look like it's merely an issue of which month do they do it.
Well, all I can see is the prospects for helicopter money. When I hear you talking about the notion that a spiking up due to the markets beyond the control of the central banks, as you point out, that interest rates start to spike up on the long end of the yield curve, affecting the housing market, maybe sending it into another tailspin downward. Businesses going bankrupt and so forth from higher rates. Unless they have revenues that offset that and they can handle it, I don't know. There some will, some won't, but. It just seems to me, Michael, we're hearing the talk from the Financial Times, Martin Wolf, others on the mainstream media talking about, well, maybe we need helicopter money now. The government needs to start shoveling money into the accounts of individuals. Ron Paul's talked about that on this show already, about how he says, sure, they can do it. Sure, they can do helicopter money. It's just not literally helicopters, but it's checks written out to Americans and put in their bank accounts. And maybe, who knows, the markets are forward-looking, aren't they? And so maybe what you're seeing in your momentum work with some of these key commodity markets, a switch, a change, collectively the markets are starting to tell us something like that could be in the cards. Hopefully not that extreme, but something more like what we saw in the late 70s, perhaps, or something like that.
Yes, I could easily see that. And it's the CBs will get what they... not what they wish for, but they pave the road. And the issue, though, is always, and this is historically true, the central banks can create liquidity, lots of it, but they don't always determine where it goes. Now, they lucked up on the stock side, starting in after the 2009 lows, especially after 2011. The public did buy stocks with the money, especially developed market stock indexes, European and U.S. and U.K., not so much emerging markets. So they seemed to get their wish. They wanted that asset category buoyed for psychological reasons and others, and they got their end result, maybe a bit more than they even wanted. The problem now is if investors shift that flow, that river of money, to some other asset category, then the CBs print more to think they could get more stock upside, for example, to protect that asset category. It's not going to go where they want it to go.
Mm-hmm.
It's going in a new preference area.
Yeah, they can't really control that. But one last question, Michael, before we discontinue our conversation today for lack of time. But I would ask you, I'm just looking at your chart over the weekend here that shows gold monthly versus the Dow Jones World Stock Index. And going back and looking at this, last year I can remember so clearly about this time, we thought maybe gold was breaking out, and it looks like it started to. And about this time last year, the first 3 months or so, and then we had another decline, a very serious decline, and it really hurt a lot of us that were long gold stocks. This year, I see a more pronounced rise above that 10-month average that you show on your charts, and also then I see on your momentum chart below, whereas last year the momentum almost got to that perforated horizontal line, but didn't get through it decisively. This year it has. Is this suggesting that this year it's probably for real, where last year it wasn't?
That's a spread chart you're talking about, the momentum of the spread, the relationship between global stocks and gold. But when you run a gold study itself using monthly bar chart of gold price, then convert it to annual momentum, I also had a breakout in February, early February, at the price of 1140 to 1160 area. So we're now $100 above there, roughly. So both of those long-term metrics of gold, both its relationship to the asset category of stocks and gold in and of itself, have broken out. I think all that we're seeing now is congestion after the breakout surge, which was about $100 above the level at which MSA had signaled major buy in gold. And it's just a congestion zone. In fact, if you think about it, bonds, for example, and gold, T-bonds, are still inverse to the S&P. I think at some point bonds could become weak like the S&P once that contagion we talked about affects them, the commodity rise. But bonds have held fairly well the last 6 weeks, while stocks have had a heck of a rally, and gold has held quite steady. You can basically draw a line through the last 6 weeks of gold action, and it just flip-flops either side of it.
Yes.
So you would expect, looking at the S&P, that gold's back down to 1,100. But it isn't.
It's not. No. Showing a lot of strength,
Yes.
Very good. Well, thank you, Michael, again for your insights. Always very valuable, and I want to thank you for spending the time with us, and look forward to doing it again, hopefully next week. So thanks very much.
Thanks, Jay.